If I told you a bank's net income plummeted like 37% in a single quarter, you'd probably assume they were on the brink of collapse. You would picture, I don't know, bank runs, panicked executives, and a balance sheet that just looks like a crime scene.
Yeah, that's the natural reaction. I mean,
Yeah.
we are wired to look at financial narratives as binary. The line goes up, you win. The line goes down, you lose.
Right, but what if I told you that same bank is actually sitting on one of the most bulletproof balance sheets in America? And on top of that, they're deploying artificial intelligence to completely rewrite the rules of commercial lending.
It sounds like a total contradiction. But the reality of modern specialized banking is rarely that clean.
Exactly. Welcome back to another deep dive. Today, our mission is to cut through that exact illusion. We've got our hands on the brand new Q1 2026 earnings report and presentation from Live Oak Bankshares, which literally just released today, April 23, 2026.
Fresh off the press.
Fresh off the press. We are putting aside the corporate jargon. We really want to understand the actual nuts and bolts of a bank that focuses intensely on America's small businesses.
And doing all of this in a sector small business lending that traditional megabanks often view as, too fragmented or too volatile to scale effectively.
Yeah, it's too much of a headache for the big guys. So we're going to figure out how Live Oak is navigating the economic headwinds of 2026, the mechanics behind their new AI lending engine, and really how they managed to insulate themselves from risk.
It is a fascinating model to dig into.
So let's jump straight into the raw numbers, because this is where that headline illusion hits you right in the face. Here is the top line number getting blasted out on the financial wires today. Net income available to common shareholders for Q1 2026 is $27.9 million.
Right.
That comes out to 60 cents per diluted share. But here's the catch. That is a 37% drop from the previous quarter. Okay, let's unpack this. If my income dropped 37% in 3 months, I'd be like selling my furniture.
You'd be in full panic mode.
Total panic. But if you look at their net income compared to this exact same time last year, it is up a staggering 187%.
Wow.
So what is the actual reality here? Why did it drop so violently from quarter to quarter if the bank is supposedly doing so well?
Well, what's fascinating here is how standardized corporate accounting can completely mask a company's operational momentum.
How so?
That 37% drop from the fourth quarter of 2025, it's an anomaly. It has very little to do with the day-to-day business of lending money and taking deposits. In Q4 2025, Live Oak experienced a massive one-time windfall.
Oh, I see.
Yeah, they recorded a $24.1 million pre-tax gain simply from selling a company called Aperture Inc. And on top of that, they logged another $9 million gain from selling a completely different portfolio investment.
So last quarter, they essentially had a giant garage sale of valuable assets, which
Right.
made Q4 look artificially huge.
Exactly.
And now that we are in Q1 and there is no garage sale, the baseline just looks lower.
Right? When you strip away those one-time, non-recurring events, the core engine of the bank is actually accelerating. You really have to look at the total revenue generated from their actual core business.
Okay, so what are those core numbers?
For Q1 2026, that core revenue is $145.5 million. That represents over 18% growth year over year.
That's significant.
It is. And even more telling is a metric called the efficiency ratio, which has drastically improved from roughly 66% a year ago down to about 59% today.
Let's break that metric down really quick because it sounds like corporate speak, but it's actually the pulse of the bank.
It really is.
The efficiency ratio basically measures how much it costs the bank to generate $1 of revenue, right? So a 59% ratio means they're spending 59 cents to make a single dollar.
You got it. And the lower that number goes, the more profitable the underlying engine becomes. For context, many traditional banks hover around the mid-60s. Live Oak's revenue growth has outpaced their expense growth by about 3 times since the first quarter of 2025.
Wait, really? 3 times?
Yeah, and they have grown their total assets past the $15.3 billion mark.
But how do you strip out 7 cents of cost for every dollar made over a single year without just, I don't know, firing half your staff or closing branches? What is the actual mechanism driving that efficiency?
Well, it is less about cutting expenses and more about scaling the asset base over a fixed technological infrastructure. Traditional banks require a massive physical footprint.
Right, the brick and mortar.
Exactly. If you want more deposits or more loans, you build another Marvel branch on a corner somewhere and hire 10 more people. But Live Oak is a digital-first, branchless bank.
Ah, so they don't have those overhead costs.
Right. As their loan volume and deposit volume grow, their overhead doesn't have to scale proportionally. The software handles the additional load, driving that efficiency ratio down.
That makes total sense. The infrastructure's already built. They're just, running more water through the pipes.
That's a great way to look at it.
But generating revenue is only one side of the coin. The other side is risk. In this quarter alone, Live Oak originated $1.37 billion in loans across 35 different industries.
It's a massive amount of capital.
Right. We constantly hear about the volatility of small businesses. Isn't pumping over $1 billion a quarter into local businesses right now incredibly risky?
Here's where it gets really interesting, because we constantly see the local restaurants closing or the contractors struggling with supply costs.
It would be incredibly risky if they were using a traditional shotgun approach, just, lending to anyone who walks through the door with a business plan.
Right.
But they use a hyper-targeted sniper model. The core mechanism protecting them is their reliance on government-guaranteed loans.
Okay, so like SBA loans.
Specifically, yes, loans backed by the Small Business Administration, the SBA, and the USDA. Their mix of these government-guaranteed loans is roughly 10 times the industry average.
10 times? Wow.
Yeah, about 40% of the bank's entire asset base consists of either pure cash or loans that carry a federal guarantee. Okay, the presentation makes a very big deal out of a custom metric they call the Mahan ratio, named after their CEO, Chip Mahan. They use it to prove just how deep this armor is. What exactly goes into calculating this ratio?
So, to find the Mahan ratio, you take their Tier 1 capital, which is the bank's core equity, essentially shareholder money and retained earnings.
Okay, tracking.
And you add two other things: their allowance for credit losses and their fair value marks. Then you divide that entire combined safety net by their unguaranteed loans.
Wait, before we move on, define allowance for credit losses and fair value marks for me. Is that essentially a legally required rainy day fund?
The allowance for credit losses is exactly that. It is a specific reserve of cash set aside based on predictive models of how many loans might default.
Got it. And the fair value marks?
Fair value marks involve adjusting the recorded value of an asset to reflect what it's actually worth in the current market, ensuring there are no hidden holes in the balance sheet.
Makes sense.
So when you combine all that solid capital and divide it solely by the loans where the bank is actually on the hook, completely ignoring the federally guaranteed portion, the Mahan ratio sits at 16.7% for Q1 2026.
Okay, so for every $100 of naked, unprotected risk out there in the economy, Live Oak has $16.70 sitting securely in a vault ready to absorb a loss.
Exactly. And in the commercial banking sector, holding nearly 17% against unguaranteed exposure is a remarkably thick layer of armor. It allows them to sleep very well at night, regardless of what the broader economy is doing.
We know government guarantees act as armor, but in the real world, how often is that armor actually getting dented? I mean, what happens when a business actually fails and defaults on their loan?
Well, if you look at the 10-year average, Live Oak's SBA net charge-off ratio, which is the actual percentage of loan value written off as a total loss, is just 0.3%.
That sounds low.
It is. To put that into perspective, the industry average for those exact same SBA loan programs over the same period is 1.1%.
Okay, how are they drastically outperforming their peers when they are utilizing the exact same federal loan programs? A vet clinic borrowing from Live Oak has the same economic pressures as a vet clinic borrowing from Chase.
The mechanism is deep vertical specialization. Live Oak doesn't use generic commercial loan officers. They have built 35 dedicated teams that focus exclusively on specific industries.
So they have a team just for vets.
Exactly. A team that only underwrites loans for veterinary clinics knows exactly what the ratio of dog food sales to surgical procedures should be in a healthy business.
Oh, wow.
They know the average cost of an x-ray machine. They know the typical turnover rate for veterinary technicians.
That's incredibly specific.
When a generic bank looks at a small business, they see a spreadsheet. When Live Oak looks at a small business, they see the operational reality. They catch red flags that a generalist would completely miss.
Okay, so you have these highly specialized teams making incredibly safe guaranteed loans. But to make a loan, a bank needs raw material. They need cash on hand to lend out.
Right, deposits.
Yeah, how do they convince these local dentists and solar contractors to actually park their operational cash with Live Oak instead of just taking the loan and using a mega bank down the street for their daily checking?
That is the eternal balancing act of any lending institution. Securing low-cost deposits to fund higher-yielding loans. Live Oak has historically been a loan-heavy institution. The strategic challenge for them is converting a borrower into a full-scale banking client.
I noticed their business checking initiative in the source material, and the numbers were really moving. Checking balances hit $409 million this quarter.
It's a huge jump.
Yeah, that is up 9% from just the previous quarter, and it is roughly 1.5 times what it was a year ago. It makes me think of a gym membership.
How so?
Imagine you have a member who only comes in to use the treadmill. They pay their basic fee, they do their run, and they leave. The gym's ultimate goal is to convince that treadmill user to start buying the expensive protein smoothies at the front desk and maybe sign up for weekly personal training. You want them completely embedded in the ecosystem.
Because a loan is a static transaction, but a checking account is an ongoing relationship.
Exactly.
When a veterinary clinic runs its biweekly payroll, its vendor payments for medical supplies, and its daily customer receipts through a Live Oak checking account, those deposits become sticky.
Stay deposits.
The business owner isn't going to move their primary operating account just to chase a slightly higher interest rate at another bank because the friction of changing all their payment routing is just too high.
Right. The presentation notes that 20% of their customers now have both a loan and a deposit account. They are successfully making the relationship sticky, which provides the bank with a stable, low-cost pool of money to lend out.
That's the holy grail of banking.
But to really scale this model, they need massive volume. They need a much wider funnel of small businesses coming in the door. How do they open that funnel without hiring an army of those highly specialized, expensive human underwriters we just talked about?
If we connect this to the bigger picture, this is where Live Oak is deploying their most aggressive technological leap. They call the initiative Live Oak Express.
What does that target?
It targets SBA 7A loans that are $500,000 or less.
Now, traditionally, doing a small commercial loan of, say, $200,000 requires almost as much paperwork, legal review, and manual underwriting as doing a $5 million loan.
Oh, absolutely.
You still need the tax returns, the business plans, the personal financial statements. The sheer friction makes small dollar loans barely profitable for a lot of banks.
The human capital required is simply too high relative to the interest earned. But these smaller loans are incredibly attractive from a risk perspective because under the SBA 7A program, they carry a 75% or greater government guarantee.
Wow, 75%, yeah.
To capture this highly insured market without drowning underwriters in paperwork, you have to completely redesign the origination process.
Enter the AI. In this exact quarter, Q1 2026, Live Oak officially launched an AI-native loan origination pilot specifically for these express loans.
They did.
So if traditional underwriting is like the regular airport security line where you have to take off your shoes, unpack your laptop, and a human manually checks every single detail of your bags, how does this AI act like TSA PreCheck? I mean, how does it actually speed up the mechanics?
Well, the AI eliminates the manual data entry and document verification that eats up like 80% of an underwriter's time.
Really? 80%?
Easily. Instead of a human staring at a PDF of a tax return and manually typing the adjusted gross income into a bank system, the AI uses optical character recognition and direct API connections to accounting software to instantly parse the financial data.
Oh, that's incredibly fast.
It cross-references the business's cash flow against Live Oak's historical models for that specific industry in seconds. It flags anomalies.
Yeah.
The human underwriter isn't doing the heavy lifting. They're simply reviewing the output and managing the edge cases.
What kind of numbers are we seeing from this? Is it actually working?
Over the last 12 months of testing this pipeline, they've sold about $140 million of these express loans, generating roughly $10 million in net gain.
That's just the pilot.
Just the pilot.
Yeah.
Their stated future target for this AI platform is $750 million or more in annual production.
That is massive.
It fundamentally changes the economics of small dollar lending. By stripping out the human friction, the profit margins on that $750 million become incredibly compelling.
So what does this all mean for you? You're probably wondering why you should care about the quarterly earnings mechanics of a regional bank headquartered in North Carolina. Why does any of this matter to someone who isn't actively trading bank stocks?
Because Live Oak serves as a hyper-accurate barometer for the macroeconomic health of the American economy.
Like a canary in the coal mine.
Exactly. If you want to know how the real economy is functioning beneath all the political headlines, look at the local businesses borrowing money to buy new equipment or expand their services. And to understand their performance, this raises an important question about our current environment, specifically interest rates.
Okay, let's talk about the weather in which this banking engine operates. The sources note that Live Oak's net interest margin, or NIA, is 3.27%. Stop right there. INEA is basically the spread between what the bank earns on the loans it gives out and what it pays out in interest to people holding deposits, right?
That is correct. It is the core profit margin of a bank's daily operations. And the crucial mechanism driving Live Oak's NIM is that roughly 73% of their entire loan portfolio is variable rate.
Okay, so because 73% of their loans are variable rate, that means the interest the borrower pays floats up and down based on the prime rate set by the Federal Reserve. So every time the Fed keeps rates elevated, Live Oak's yield on those loans stays incredibly high. Meanwhile, because they're gathering those sticky operational checking deposits we talked about, where a business owner isn't demanding a 5% yield just to hold their payroll cash, the bank's cost to fund those loans has essentially flatlined. They capture that massive spread.
They're perfectly positioned for a higher-for-longer interest rate environment. The macro weather is highly favorable for their specific balance sheet structure.
But wait, conventional wisdom says if money is expensive, businesses choke. If a small business took out a variable rate loan 3 years ago, their monthly payment has skyrocketed. They shouldn't be surviving 7 or 8% interest rates. The doom and gloom narrative suggests these businesses should be defaulting left and right.
And yet, the data from Live Oak completely defies that narrative.
How so?
Their non-accrual loans, which are loans where the borrower is in such distress they have completely stopped paying interest, are sitting at just 1.02% of the portfolio.
That is shockingly low.
And it comes with a major caveat. The presentation explicitly notes that about 27% of those non-accrual loans stem from industry verticals the bank has already exited.
What does an exited industry mean in this context?
It means legacy portfolios. Years ago, the bank may have experimented with lending to a specific sector, realized the risk profile wasn't ideal, and stopped issuing new loans to that industry entirely.
Ah, see.
But they still have old loans winding down on the books. When you remove those legacy mistakes, the default trends for their active, core small business borrowers are actually stable to improving.
So the local pharmacist, the veterinarian, the solar contractor, despite inflation, despite the high cost of capital, they are making their payments.
They are.
This is the biggest takeaway for me regarding the broader economy. The American small business sector, at least the slice of it vetted by Live Oak's specialized teams, is showing remarkable resilience.
It really proves that while macroeconomic headlines can sound terrifying, specialized businesses with strong underlying cash flows, underwritten by a bank that actually understands the mechanics of their specific vertical, can thrive in almost any rate environment.
So to pull all of these threads together and wrap up our mission today, Live Oak Bancshares has engineered a Q1 2026 that might look soft on the absolute surface if you only glance at the net income drop.
Right, that headline illusion.
But beneath that headline illusion, it is a masterclass in structural banking strength. They are utilizing a heavily government-backed portfolio to negate raw economic risk. They are pushing sticky business checking accounts to lower their funding costs. And they are deploying high-tech AI origination to aggressively capture the smaller loan market with incredible efficiency.
They have basically taken the traditional, sometimes chaotic, paper-heavy nature of small business banking and applied a rigorous, highly technological, and heavily insured framework to it.
Which leaves me with a final thought for you to mull over as we close out. We talked about how AI pilot programs are stepping in to instantly parse tax returns and originate small business loans at lightning speed.
Yeah, TSA PreCheck for banking.
Exactly. And we know those loans are mostly backed by the federal government. So what is the future of relationship banking? When commercial lending becomes a seamless game of algorithmic speed and federal safety nets, does that traditional human element, the classic image of a local business owner looking a banker in the eye and getting a handshake loan, does that disappear entirely? Or does it simply evolve into something we've never seen before, where the software handles the risk and the human banker is finally free to only handle the relationship?
It is the ultimate question for the next decade of finance. Who holds the power, the algorithm that approves the money, or the human that understands the dream?
It really is. Keep digging, keep questioning the headlines, and we'll catch you on the next deep dive.